Okay, so let's start out this week talking about your column.
Yes,
once again. So 2 weeks ago, you tried to upend the one thing we all knew about investing in the stock market: buy low, sell high.
Right. Bad advice. Don't do that.
And now you're taking the second thing we know.
Right.
Which is to balance your portfolio 40% bonds, 60% stocks.
Right.
Throwing it out the window and saying, no, 100% stocks.
Well,
explain why that is
it's not a terrible thing. If you did 60-40, fine. It's better than putting it all in cash. On the other hand, it is going to end up being somewhat of a moderate return profile over the years. And some would argue, and super smart people have argued, that nobody can stand the volatility of 100% stocks, so that the only way to do a riskier allocation than 100% stocks would be shut your eyes, go Amish, like cut off all of your access to media, and wake up like Rip Van Winkle 40 years later, having never moved your stocks. And that is the only way to do 100% stocks. And in some ways that is true, or to develop the ability to be a little bit media naive and say, I'm not going to be bothered by what's happening. But overall, you'll have more money in the end if you have 100% stocks. Lots of people disagree with me. All investment advisors disagree with me. Not so much that you'll have more money in the end, but that this is a doable thing for most people. And they have strong grounds, which is that it is a volatile or bumpy ride. And as I cynically say in my post, you'd probably, in the course of 3 decades, if you had 100% stocks and your investment advisor had suggested it, you'd probably have fired them. After a decade, it goes down, you're fired. Like Donald Trump, you're fired. And then it goes down again 20 years later, and you're 100% stock. Hey, you're fired. The next one. So you'd be on your 3rd investment advisor by the time. So in order to retain you as a client, they go, no, let's do a 60-40, and that way, if the market goes down, they're like, hey, but I had you 40% in bonds, so that's good. The results will be worse than what I say you should do, 100% stocks. But you'll retain your investment advisor.
The 60-40 thing is career insurance?
Yeah, absolutely. That's my cynical view. There are other more substantive reasons for it, and it's not the worst thing in the world. But if you want more money, which I think most people who aren't yet wealthy need, more money.
So explain kind of what your underlying argument. Like, why will you have more money at the end of 4 decades if you have 100% stocks over a split between 60% stocks, 40% bonds?
Right. So if you look at the time period of stocks versus bonds, just super simple basket of one versus the other. In a short time period, they're fairly comparable. You might have, over a 1-year period, pretty comparable returns, 3% here, 4% there, or you might even have bonds will be 2% here and stocks are -15, and you go, oh, I know which one I want. But as you sort of pan out, if you go from like Google view of 1 block to Google view of 1 mile to planetary views, and that's all an analogy for 1 year to 5 year to 20 years to the 100-year view. The return from risky stuff, stocks, versus the return for non-risky stuff, bonds or cash, goes basically logarithmic, and so you have so many more times return on risky stuff. I mean,
I'm still stuck on logarithmic. Okay.
So the returns of bonds are sort of linear and slow growth. Returns of stocks go volatile, but eventually go, using another inappropriate math term, asymptotic. Like, you turn $1 into $10,000 over 100 years, and you turn $1 into $25 over 100 years when bonds.
Okay.
Anyways, have I lost you all yet? Anyway, the longer your time horizon, the more likely that the returns from stocks will beat bonds, and that the returns will so far beat them that it's an outrageous beating that you wouldn't even, once you realize that the 30-year view, you would never consider bonds.
So what do you hate about what do you hate about bonds? There must be something you hate about bonds. You claim not to.
They're steady. They're steady. They're safe, and they preserve nominal value. What they don't do is.
Which means what?
Which means you start with $100, you end with $100, and you get a little bit of interest in between. But all of money erodes its value over time. So the big thing is, are you getting any return after inflation? And usually it's super minimal. And are you getting any return after taxes? And now you're down to super low returns. So I'm going to use super simple numbers, which are, forgive me because they're super simple and simplified, but if the returns for stocks versus bonds pre-tax and pre-inflation is maybe 2 times as much, you make 2 times as much in stocks and bonds over the long run. After taxes and after inflation, which erodes your money, the returns to stocks versus bonds is more like 4 times. And I can't prove this in the course of the thing, but read a couple of books, Simple Wealth, Inevitable Wealth by Nick Murray, and the other would be Jeremy Siegel's Stocks for the Long Run.
So have you made the transition with your own
Oh,
portfolio?
yeah.
Really?
Fortunately, 15 years ago, anything I ever had, I've always had 100% stocks.
So how's it done?
So it's a totally
Generally speaking.
It's a totally bumpy ride, but it's in the long run, I don't know, way better than if I
Okay, so in your piece, you mentioned the, what do you call it, the financial entertainment?
The financial infotainment industrial complex.
Yeah, which is a very real thing. I mean, I totally understand that. So
you were part of it?
I was part of it, yes. I guess we're kind of part of it now.
Kind of part of it, yep.
Part of it right now. So how do you avoid that kind of noise? I mean, presumably you follow your investments to some degree. How do you just block all of that out? It's like so much of our environment. How do you just tune it out?
Well, I read a lot of books.
Oh, okay. Well,
I don't have a television, but I mean, obviously I read a lot of stuff online. But I have, changed my mindset, which is I filter it and say, most of this stuff that you see is somebody is selling you something, and I know that because I was selling stuff in the past, and so I know the thing that all investment professionals who you see on TV are selling you something. All I'm selling you is my blog, basically.
Right.
Anyway, which is free. But anyway.
Mine too.
Yes, free blog. So you just understand the filter and you kind of go, this prediction about the future or this call on the market is not real, it's a sales job.
Right.
And that's important to understand, and most people don't because it's never said, hey, this is all a sales job, but I'm just going to say, it's all a sales job.
Okay, great.
Yeah.
All right, I will totally buy it.
It's all sales
and
job.
you're eating your own cooking.
Oh, absolutely.
Taking your own medicine.
Yeah, every time somebody asks me, I'm like, this isn't what anybody else is going to tell you, but I'm going to tell you, and here's the reasons why. And so I figured I'd finally write it out.
Okay.
So I'd have to stop saying it.
I'm going to stick to 60-40 for a while. I need to be convinced yet.
Everybody does. Everybody does. I just want you to be wealthier, though.
Right.
Yeah. I want you to make.
I want to be wealthier too.
As though I don't want him to die poor.
Right.
So.
And I don't want to die poor.
Yeah. That's what my partner at Goldman used to say. I don't want you to die poor, and then he'd give me some good piece of advice.
Okay.
Yeah.